because a business in transition needs to be able to support multiple generations. And before beginning the process, it's really important that you get a handle on where you stand in the first place. As we look at your business and analyzing its financial health, we have to take a big step back and remember, why are we in business in the first place? And this is an important question to ask as the junior generation is coming in and looking at what their long-term goals are with this business. And at the end of the day, we're in business to be profitable. We need to make a return to the capital that we have invested in the business, because we could be investing that capital somewhere else. We need to make a return to the labor and management that we're providing to this business, because we could be providing that labor and management somewhere else. And a lot of times we're also in business because it fits our lifestyle goals. There's something about farming and running a farm business that we love and we enjoy, and we can balance that as long as we're also getting a return to our capital and labor and management. At the end of the day, our business objective is profitability. We have to know, are we actually making money? And are we really truly making that money in cash? Are we making money with or without appreciation? So in other words, is it just the growth in value of our assets that's driving profitability, or is it actual business returns? And are we really providing a true return to the owners for their labor and management? Are the owners subsidizing the farm by working for less than they're actually worth? And are we profitable enough to also support a retiring generation as well as an incoming generation? The transition process isn't a direct handoff, and the business needs to be able to generate profits that support both generations at the same time, which means that there must be profit growth coming from somewhere. Transition planning puts a lot of cash flow demands on a business. We have the incoming generation, and they need to be compensated for their labor and management. The other issue we run into a lot with an incoming generation is an increased value on work-life balance, which is a good thing. But as we look at our business and we analyze the health of business and its ability to support this transition, we have to look at what that structure is going to look like. If we have an incoming generation that wants to be able to better balance their outside life and their family life with their work life, it may require that we need more labor or a different structure of labor, or to find other efficiencies within the business to make that happen. And is that going to require more capital or additional cash flow? And we also want the incoming generation to have the ability to build off-farm retirement and savings. We know that this is crucial in the long run in terms of their ability to transfer the business on when it comes time for them to look at their transition planning in the future. For the retiring generation, we look at a lot of things. One is, are we really honest about what our living expenses are? For a lot of the senior generation, their actual living expenses versus their perceived living expenses are very different, because there are still a lot of personal expenses that are being paid for through the farm operations. Think of things like fuel, vehicles, cell phones, insurance, personal real estate taxes. Depending on how your business is structured, a lot of those expenses could still be being paid for through the farm. And even though it's not a check that comes out of your personal account every month, it is a living expense. And as we look at what expenses the farm is really supporting in terms of the senior generation, we need to get a good handle on what their true living expenses really are, and whether essentially they can afford to retire. We look at what the retiring generation's equity position is. And then the question becomes, how much of that equity are they planning on redeeming and over what time period? Right? So they may have on paper, say, $2 million worth of equity in this business. The question is, do they actually want to take that $2 million? What does the buy-sell agreement allow them to take? How long do we have to pay it out to them? Are there off-farm children that they want to consider? Are they interested in leaving some of their business interests to off-farm children so that they can get a continued cash flow stream as well? A lot of times we see this in the form of rents. We see parents leaving their land holding LLC or some of their land ownership to off-farm children so that they can continue to get some type of benefit through rent payments. And the farm needs to understand what that cash flow demand is going to be to the business itself. Does the retiring generation have outside wealth that they've built up over time? And in that case, that may affect how much of their equity that they need or want to take out of the business through retirement. And then on the flip side, does the need line up with the value? So if we say that when we draw out the retiring generation's living expenses and how much they really need to retire on, do we even have enough equity in the business to meet those retirement needs? Or do they need to continue working in some way? Or do we need to find other ways of, perhaps providing rents through land ownership? How do we need to structure that so that we're covering their cash flow needs without bankrupting the business? So all these things kind of can put a lot of cash flow demand on the business. And as we start this transition process, knowing that we are going to have these increased cash flow demands, we need to take a step back and look at how our business is doing in the first place and whether it's in a position to eventually meet those cash flow demands. And that starts with really knowing your numbers. Okay. A lot of us are guilty of keeping records for compliance, records for doing tax returns, records for our lenders, but are we really using our records for management? Do we really understand from our records just how profitable our business is? So what numbers is it that you're managing from? Are you just looking at your checkbook balance? Because your checkbook balance at the end of the day doesn't tell you a lot about the health of your business. Outstanding bills, changes in inventory, using up prepaid, things like that. Now we start to get a little better feel for the true, accurate health picture of the business. And then the next step is consolidated financial statements. Okay, so now we've got full accrual statements that pull together the whole business picture. And then we start looking at trends. And this is where it really becomes important. We can start with monthly and quarterly trends, but the real value is in multi-year trends, because consolidated financial statements do give you a one-year snapshot of your business's performance. But what really matters is the health of your business over time. So quality records, if we're going to use records for management and to really look at the business accurately, they need to be timely, which means they need to be kept up to date and current at all times, not just done at the end of the year for a tax return. They need to be truly accurate. And that means probably having a third party review and audit them, whether it's an outside, whether an preparer or an outside consultant, having someone go through and make sure that everything is reconciled and that everything's being accounted for correctly, and that they're truly complete. And that they're available to everyone in the business. So basic financial statements that before you can begin any kind of analysis, at minimum need to have a profit and loss, and they need to be available in both cash and accrual. Okay? Because you really have to have a handle on what your gross operating revenue is, what your gross operating expenses are. And as you know, cash records don't always truly reflect what your gross operating expenses are if you have either had prepays coming into the year, or if you perhaps have put off paying some things, you've accrued those expenses even though they haven't been accounted for on a cash basis. We also need to have an accurate balance sheet. It's important to understand the difference between a book balance sheet and a fair market value balance sheet. So I'm just going to go over that quickly. Remember that book value is your tax basis in the assets and liabilities. And what that means is probably what you paid for the assets in the first place, if we're talking about depreciable assets, minus the amount that's been depreciated over time. Okay. Now, a fair market value balance sheet, on the other hand, reflects the true value of those assets if they were to be sold out on the open market today. So, for example, two places where we see big differences between book value and fair market value would be in land values and in raised cattle. A lot of times land was purchased a long time ago. It may have been purchased for a couple $100 an acre, and today it's worth several $1,000s an acre. So on a book value balance sheet, we'll only see that initial purchase price. On a fair market value sheet, we'll see the true value reflected, and that's a big difference in value. Okay? We need to know what our total assets are, as well as our total liabilities, and it's really important that within those liabilities and assets, they're broken out into short, intermediate, and long term, so that we really understand what our, what our liquidity position is. All right, so let's talk about basic business assessment. We're going to spend a lot of time today talking about calculating financial ratios. Now, as you know, there's a lot more financial ratios than this. I've tried to isolate a few that I think are simple to understand, but also kind of have the best, do the best job of really capturing the health of your business and have the strongest impact on your business's long-term viability and ability to be transferred. So we're going to look at profitability ratios, liquidity, solvency, your repayment capacity, which is really important when we talk about having to get additional capital, whether we can pay it back, and then financial efficiency, which is how well are we using the assets that we have. Okay, and then we're going to take those ratios and we're just going to talk a little bit about how to benchmark them, or how to compare them to industry standards, because the number itself doesn't mean a lot unless you can compare it to a scale or a standard somewhere to know whether the number is good, bad, or otherwise. Yeah. So we'll start with profitability. A business has to be profitable, and we've talked about this earlier. In order to maintain the ability to meet family goals, to build that retirement for both the senior and the current generation, and also to reinvest in the business. Are there earnings being left on the table? Where could we be more profitable? So first we want to look and see, where do we fall from a profitability standpoint? The first place to look is at the rate of return on assets. So this is the amount of returns that are being generated to the amount of total assets that we have tied up in this business, okay? Or the rate being generated for all of the money that's invested. And you can think about this if you had money out in the stock market. If you're getting less than a 4% return, you may want to start asking some questions about whether this is the best place to have your money invested. Now, this is where it's important, though, to go back to what I said earlier about looking at trends over time. In 2017, 2018, we absolutely had farms that had less than a 4% return on assets. Does that mean that they're in a bad investment over time? Probably not. What's more important is that we look at the long-term trend. Over the last 20 years, what have they returned? And in those cases, it's usually up in the 4 to 9 and even higher than 9% range. But that's where it's really important to look at your business. If over the last 20 years, or even over the last 10 years, you've averaged less than 4% returns, now we need to start looking to say, okay, is our business, why is our business not profitable? And we can talk in a few minutes about areas of opportunity to look at. But it should be a red flag if you're looking at transitioning this to a next generation. Another good measure of profitability is our rate of return on equity. And this is just, again, that rate of return, but just on the portion of the business that we own rather than the bank. So that's the rate of interest that you're getting on your money that you have tied up in the business. Okay. And so in this case, we'd like to see a little bit higher rate of return because this is your risk. And now we want to see at least 5%. Healthy or stable would be in the 5 to 10% range. Strong would be over 10%. Again, looking at trends over time. Don't just isolate your 2018 numbers. We're going to talk a little bit about liquidity. So what is liquidity? Basically, it's your cash available, right? So it's the near cash that you can get to in a short amount of time. So what is the ability of the business to service its debt in the short term? Okay, short term being 12 months or less. Why is it important to have liquidity, this cash reserve? Well, one is if there's a shock to the system, right? So if something goes wrong in your business, if there's a shock to operating efficiency, something breaks down, you have a severe strain of mastitis outbreak that you can't get a handle on, something that really disrupts your business's cash flow, how well positioned are you to handle it? Or an outside force like a low milk price cycle, and we're seeing the effects of that today, right? We've had a prolonged low milk price cycle, and or I'm sorry, not just milk price, really, for any commodity, a low price cycle. The businesses that had stronger liquidity coming into the down cycle are better positioned to handle it and come out the other side. So a good analysis for liquidity is looking at our working capital to operating gross expenses. So working capital is really cash available. It's your total current assets minus your total current liabilities. And we said this is why it's important to be able to separate those assets and liabilities into current versus intermediate versus long-term. Current is cash that you have available today or near cash that's available within the next 12 months. So it may be accounts receivable if you have accounts receivable as well, minus your total current liabilities. So your current liabilities is generally made up of your accounts payable and the current portion of your intermediate and long-term loans. Okay. So then we can take that working capital number and divide it by the total expenses. That's why we said it's important to know the total gross expenses of your business back on your income statement. It's that the bottom line of your expenses on the income statement. Got to be able to divide the working capital by total expenses and see how much of those, what percentage of those expenses do you have available to you as excess working capital, okay? And here's a good range. If it's less than 18%, you may be in a very weak liquidity position. And again, after a long period of a down cycle, there may be a lot of businesses that have fallen down into this range because they've eaten up some of their working capital to kind of survive through this low price cycle. But it becomes really important that as soon as business is able to start rebuilding that working capital and rebuilding that liquidity. After liquidity, then we look at solvency. So solvency means if everything were sold tomorrow, can we cover all of our debts and how much is left, right? And so when we think about the debts that we have to meet if the business is sold, we've got creditors, we've got IRS, and then the owners come last, right? It's whatever's left over is what's available to come back to the owners. So really when we look at this, we say, okay, how much of the business is owned by the lender? And as many of you are probably very familiar with, this becomes really important when you go to borrow more money, right? If we need to raise capital, if we need to, borrow money for a capital growth project, especially as we're talking about this transition planning and bringing a next generation in, we're looking at ways to make the business more profitable, or even to grow the business in terms of management structure and making management room for a next generation to come in. A lot of times that requires some type of capital investment and capital project. Are we in a position where we're able to have that capital available? And solvency is a big part of that, right? So we look at your equity to asset ratio, total net worth divided by total farm assets. In other words, how much of this business do you own? Remember, net worth is assets minus liabilities. So what percent equity are you at? And that's probably the phrase you're most familiar with here, called percent equity. If you're less than 45% equity, you may struggle to get any additional capital. Lenders become very hesitant when you fall below this mark. 45 to 75% range. Even honestly, 45 is a little on the lower side, especially if your earnings are very strong. You may still struggle to get capital. This 45 to 75% range is generally considered stable. If you're over 75%, you're in a very strong capital, strong equity position. Now, that doesn't mean that you're guaranteed to be able to have access to capital, because there's certainly other factors that go into it, and your earnings are a big part of it. But it's very, very helpful and a very important part of the equation. Repayment capacity. Okay, we mentioned this earlier. What is your ability to service your debts? And then what do you have left over after the debts are serviced? Are you able to replace capital items? Okay, are you, if you are not, buying and financing capital purchases, if you're paying for them out of cash flow, are you building up reserves to replace them over time? You've probably heard the term living off depreciation, right? So you appear to be profitable, but over time, your assets are starting to depreciate and you're just not replacing them and not replacing them. Eventually, that expense is going to come up where you're going to need to replace those capital items. How is that being handled? Are you building up money to do that? Or do you have the ability to repay, to make the payments if you need to finance them? Do you have the earnings available to service that debt? So we look at your term debt coverage ratio, okay? And that's your capital debt repayment capacity divided by your planned principal and interest payments. In other words, did you have enough income generated by the business to cover all of your debt service? If it's less than 1.3 times the amount of planned principal and interest payments that you had to make, you may struggle to get additional financing and to finance those additional capital projects. In the 1.3 to 2 range, now we're looking at a healthier, more stable business. The other number we can look at in terms of repayment capacity is your replacement margin coverage ratio, okay? So what does that mean? It's your capital debt repayment capacity divided by those planned debt payments and your unfunded capital replacement, okay? So you said, if you didn't replace capital items, what is your plan to fund them? Okay, so we say, at some point you're going to need to replace them, and we call that unfunded capital replacement. So did you make enough money? Did you generate the earnings that you need to both replace that capital and pay your debts? So obviously this ratio is going to be a little lower, right? Because it's the same one we looked at previously, but now we've also thrown back in that additional piece of being able to replace capital items as well, okay? So here's where if you're below 1, then you may struggle to replace capital items as they come up. You may not be able to take on additional debt, and basically less than 1 means you're just not generating the earnings to both pay your debts and to replace capital items, so you truly are living off depreciation. The last piece we're going to look at in the business assessment is financial efficiency. So how well are your assets generating revenue? Where is that revenue going? Okay, so of all the capital and money that you have tied up in these farm assets, are you using them to the best of their ability? And how much revenue are they generating back to you? So is that revenue going toward operating expenses, interest? Is it going toward depreciation? And after all those things are covered, is it then going toward building profits? Okay. How can we improve those earnings and improve the efficiency? This is an area that a lot of businesses are looking at harder and harder as margins have been tighter through this low price cycle. Are we using all of our assets to the best of their ability? And is there a way that we could maximize the use of this in capital that we already have tied up in these assets? So how do we look to see whether we're doing a good job of that? And that's starts with your asset turnover ratio. Your gross farm revenue, so all of the money generated, remember that's the top side of your income statement before expenses, all of just the gross sales. So if we're talking about a dairy farm, we're looking at your milk sales and your cow sales and your calf sales, maybe some crop sales, all of those revenue items divided by your average farm assets. So your average farm assets would be the average value of all the assets you had throughout the year. In other words, what did you generate in sales for the amount of dollars that you had invested? If this is less than 0.5, you may have too many assets or not be using them well enough, okay? And maybe that means we have land that isn't being used efficiently. Maybe it means that we have too many pieces of equipment or too large of equipment for our business, or just equipment that isn't being used efficiently enough. And we need to start looking for opportunities to better utilize that capital that we have tied up. Okay, so once we've run through all these ratios and we've gotten an idea of where we sit within our business and where we fall in terms of the benchmarks for those profitability ratios, now we can kind of tie that into a SWOT analysis of the business and say, what are we doing well? Okay, if we look at those ratios, where were the areas where we looked like we were really doing a good job? And where are we leaving money on the table? Okay, that's our weaknesses. Strengths, what are we doing well? Weaknesses, what could we be doing better? Opportunities, where are our opportunities? And then threats, what are the biggest things that could disrupt our business? Okay, if we have very low liquidity, a low milk or a low price cycle of any sort is a big threat to our business and could disrupt our business if we're not don't have the capacity to handle that business shock. So let's look for a minute at the profitability equation. There's 4 pieces that make up profitability: volume, our net price, so our price minus cost, and our investment. And so when we look at the SWOT analysis and you think about evaluating, strengths and weaknesses and opportunities for a business, remember that there's only 4 areas that you can affect that will affect profitability. Volume, the number of units that you ship out. Price, the price that you receive for your product. Cost is your cost to produce it. And your investment level, how much capital you have tied up in producing that product. So where are your opportunities to improve the business? Well, volume, we can increase volume, right? That'll drive that profitability number up. We can increase price sometimes, right? So there are some price factors that are within our control. Cost, we can decrease our cost, and that has been the primary strategy of attack for businesses over the last few years. In this down cycle, they've really taken a hard look at their cost control, and tried to reduce operating expenses as much as possible. And then there's the investment level, and this is one that we don't think of a lot, but by reducing that level of investment per volume, we increase profitability. So this either means, we either need to increase the top section, increase volume, and spread that volume over, spread that investment out over more volume, or we could look at decreasing our investment, decreasing the amount of assets that we have tied up in that business. So important things to remember when we're looking at this business assessment, and this is a reminder, no one measure gives you a full picture of your business's financial health, right? You have to look at the whole cumulative financial picture. And when you're looking at all of these numbers, you have to have a frame of reference as well, okay? So, for example, where is the business in the stage of maturity? Is this a first generation startup farm that's only 5 to 10 years into production? Is this a 5th generation family that's been able to build, equity over time, and where does the business stand in its stage of maturity? Is it going through a growth period? And if so, some of those ratios may not look as healthy as in a period of stability. How do the ratios compare to where you want them to be and where the bank wants them to be? And this is where it's important to be having conversations and discussions with your lender, having that relationship to know where the expectation is. And then, of course, we've talked about this a few times throughout the night. What type of year was it for the industry? This is why it really can't just look at 1 year isolated. You need to look at your trends over time. So as you're benchmarking against industry data, okay, it allows you to then track that business performance over time, looking at those trends. You can also identify areas to improve, emphasize, or discontinue by comparing your data to other performers in the industry. Okay, and this becomes really important. Again, just like how looking at one number on its own is not helpful unless you know where it falls in terms of benchmarking. Looking at your business as an isolated snapshot doesn't really tell you a lot until you see how you compare it to your industry peers. Okay. So some resources for this type of business assessment, if you're not familiar with them already, there's the Farm Credit Business Analysis programs. There's the large dairy program that they run, the Farm Credit Benchmark program. They do a retail benchmark. I believe they have a winery benchmark as well. If you're in the dairy industry, we have the Cornell Dairy Farm Business Summary, which is a free tool, which is a good way to get your data benchmarked against other performers in the industry. And again, these are dairy specific ones. I apologize. Deem and Associates also provides a dairy dashboard, which also pulls in some industry benchmarking. Outside of dairy, and even within dairy, one of the best resources is your Cornell Cooperative Extension teams. You have both county and regional business management specialists that can help you pull these numbers together and get a better handle on where you stand. Profit teams, whether, profit teams have become really, really important in getting an outside perspective on your business. And they can be made up of anyone who you really feel contributes value to your business. For example, I sit on a lot of profit teams alongside of a vet, a farm credit consultant, a loan officer, a nutritionist, and occasionally an attorney or an accountant. But it's a way to pull outside advisors together, and they generally meet quarterly, sometimes semi-annually. We do have some that only meet annually, but that doesn't really give you quite as much ability to kind of get your finger on real-time performance and make adjustments throughout the year. But they've become a very popular and really important way to keep outside perspectives and keep a finger on the pulse of your business. And then, of course, there's outside business consultants and accountants who can kind of help you pull these numbers together and provide some benchmarking resources as well, and other agri-service personnel. All right, so thank you. I really appreciate your time tonight.